Good morning, everyone, and welcome to our morning market briefing. And our presenter this morning is Mr. John Person. If you're interested in what the Federal Reserve has to say or has been saying, this is the week for you. Not only are the notes from the last FOMC meeting going to be released on Wednesday, several Fed presidents will be talking this week, including 3 today and again on Friday. The market has moved higher after recent lows, but last week the stock market struggled and couldn't really continue that upward trend. Geopolitical concerns may be part of the reason that the market has stalled. Our potential trade war with China has been placed on hold for now, according to Treasury Secretary Steven Mnuchin on Sunday. Overnight, the MSCI Asia Pacific Index slipped 0.2%, while Japan's Topix Index closed 0.1% lower, with banks and insurers the biggest losers. In Europe, the Stoxx 600 Index was 0.4% higher at about 6 a.m. Eastern Time, with it as an earlier sell-off, and Italian stocks eased. German equity markets were closed for a holiday. The S&P 500 futures pointed to a gain at our opening. We'll keep our eyes on that as we near the market opening. The 10-year Treasury yield was again over 3% at 3.073. Gold was lower. Canadian stock markets will be closed today as well for Victoria Day. Micron Technology holds its annual analyst and investor meeting. Remember that everything we talk about here at the Morning Market Briefing is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss are for demonstration purposes. They are not recommendations. The presentation is not an offer or a solicitation of any kind anywhere where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading may not be suitable for you. It is not suitable for all investors. And please take a look at the disclosure information, these important pieces of information I've posted in the chat panel for your reading pleasure, are regarding the characteristics and risks of standardized options and the other asset classes that we cover here at TradeStation. Mr. John Person, our presenter today, is a full-time trader with decades of market experience. He's a registered commodity trading advisor and president of nationalfutures.com, an investment advisory service. He is the author of several best-selling trading books. He appears regularly on a number of financial venues, including the CBS Market Watch, Reuters, Dow Jones, Newswires, and others. So let's join John as he examines opportunities for the upcoming week using criteria such as Person's pivots, his proprietary indicator, and seasonal strengths and weaknesses based on his Commodity Trader's Almanac book. Our session today is designed to help you take advantage of momentum and price levels in various futures, stocks, and stock sectors. Let's welcome John Person to the Morning Market Briefing.
Now the cue to present both my room and TradeStation. Good morning, everybody out there. We were just going over what happened in last week's activity in the marketplace and where we stand. Last week we announced that we were no longer long the Russell and that I am looking for the S&Ps to kind of outperform relative to the Russell. As soon as I made that announcement on Monday with TradeStation, on Tuesday I told my community, I think I made a mistake. We're not short the market, but there seemed to have been a breakout as soon as Tuesday came. And what I wanted to point out to you guys, both TradeStation and also my community, as I punch up the daily charts here, I heard Don had mentioned about my trading books and the technique of looking at the on-balance volume as well as looking at the advanced decline was in the book called Mastering the Stock Market, and the techniques used for equities, seasonality, and of course volume analysis in chapter 6 of that book. And so some of the things that we talk about, not just in the volume analysis, which I find very important, but also looking at the breadth of the market that was also covered. And as well, one other topic that I like to use, which we created an indicator over here called comparative relative strength, the PMC indicator. So comparing a market to the overall percent change performance to the benchmark and a sector. Generally seems that institutions and people, money chases money. And so when we have something that's going up in value, but yet it's weakening in its performance, in its percent change against the broad market, it shows a divergence of strength. And it's a study in and of itself, and it's an important study because it is something that is an added tool when trading equities. I find that different markets of different time frames, certain indicators work best for those. One of the indicators when we're trading with indexes, and that's why every Monday I've come in with TradeStation and we start our week off with how is the overall health of the market? Meaning, is the rally, is it going up on strong volume? Is it going up with accumulation of stocks within that index? Or is there a strong concentration, or is it just a select few stocks going up with the price of the index? And that tells us what the condition of the rally is, the strength of the market. And so, quite frankly, the Russell, as you know, since I think back in March, we were anticipating to see the Russell outperform relative to the rest of the markets, and that was a successful trade, and we now are moving on. So what am I looking at now? Using the same tools and the same techniques to help everyone for the week. If we have a feeling that, or through evidence, not a feeling because I just woke up bullish, but if we have evidence that supports a strong market, then it gives us the inclination that we don't want to be A, short, and B, we can still look to buy certain stocks, so that if the overall market is still healthy, then we should still be on the long side of the market. And as far as the Russell, it's one of the very few indices last week, the advanced decline as well as the volume broke out supporting the rally. So this suggests, by all stretch of the imagination, it does suggest there's still continued strength in the marketplace. So a lot of people feel that the Russell small cap growth is really where, if we do see value and acceleration in the small cap, it suggests that people are willing to not gamble, but be more risk-taking. Risk on is, I guess, the phrase that everyone likes to use in this day and age. But it can also suggest leadership in the market at times. But what we need to be on guard for is market conditions that may tend to get overbought and overstretched. And some of my other tools suggest that the Russell is getting slightly overbought. One of the tools that we have at this point in time to look at is on a weekly basis, the momentum indicator. And again, when we compare the relative strength of the Russell versus the S&Ps, and that's what this one indicator at the bottom for TradeStation users I'm sharing with you. A couple things that we could see. While this is a special volume indicator, VM indicator, this comes in the person's lifetime. This is a really sophisticated tool in the sense that it measures both the momentum of the volume change and the change in terms of percent movement, not actual volume. So it does help us. It's something we developed because we're seeing changes in how we trade and what we trade, diluting volume analysis. And what I mean by that, without giving a class in volume, think of dark pools, think of what institutions can do behind the scenes. Think in terms of how many ways can we trade the Russell. You have the IWM, you have the RUT, we have options, we have futures, we have options on futures, and then we have a basket of stock in ETFs that can be traded to make and mirror your own index and just take select sectors. So what makes the Russell tick? Smaller regional banks, smaller pharmaceutical biotech stocks, as well as smaller cap energy stocks. So if you wanted to take a blend of the best, so to speak, you can create your own hybrid index, and that's what's going on an institutional scale behind the scenes. So therefore, we're not maybe seeing true volume come into maybe just the Russell. So therefore, I hope that was a great explanation of why we have not altered, but maybe changed indicators to reflect the new demands of time and what is being and how we're trading the markets. If that, I hope that made sense for a lot of people. So it's kind of like keeping up with the new millennial type of trading. I didn't invent this hybrid fund of fund type of trading. I didn't trade and invent volume. I didn't invent percent changes. I just put all three together and came up with a better reflection of value. And so what I'm seeing right now with the Russell is that first and foremost, my person volume histogram on looking at the small cap IWM. In my room, I'm sorry, but you can't see this one. We are starting to lose a little bit of momentum, bullish momentum. You can clearly see that this indicator is lower than readings in the past peak. And so when you look at the on-balance volume, yes, it broke out to newer highs. My volume indicator does not show the same type of percent change in that last leg up relative to this leg to the upside. So from October through October of last year through December, we had a greater volume thrust and sideways action. And then the move from the beginning of the year till now is on lighter relative change in volume. And that does reflect, look at this leg here in on-balance volume. When you look at on-balance volume, when you say, well, what is going on here in the marketplace on a weekly chart? So let me get this, because this is kind of a good way of studying the market and learning of what's going on in this world, this day and age. So when we look at the a quarterly basis change from, say, this October low going into the end of the year, there was a pretty strong change relative to the current change right now. We had in this, looking at a quarter to kind of a quarter, in this case we're dealing with a little bit more time, but less volume changes. So that, number one, tells me there is a trailing scenario with volume. Next, the relative strength versus the S&Ps. While recently this person market catcher is turned bright blue, and it started back in March. In fact, this is when we started to tout that we were starting to see improvement in the relative strength of the market. It started to turn that fuchsia color from red. So we went from a way over extremes, oversold, to starting to improve and then outperform the broad market. And that's why we've been on the, part of the reason was this indicator here helping us to detect that the relative strength of the Russell was outperforming the S&Ps, and that's what this tells us. So now, why would I say I think it's over? Well, it may be time to get off the train ride. We were at a resistance, and I had weakening momentum, weakening volume, and the relative strength versus other times in the past was not as strong. So therefore, it made sense that it was time possibly to take a step off the elevator ride, so to speak. So what do I think is going to happen from here? Do I see an overall downside move? I see a correction coming in the market, but I think it's just going to be one that's more indicative of what we've been going through, and that is that sector rotational grind in the market. I think semiconductor sector, we're starting to see some relative weakness coming in the semi space. And while we don't have official sell signals in semis, and what do I mean by official sell signals? Using TradeStation's radar screen, if I go up, I'm looking for either my proprietary published low or high close doji signals, or I'm looking for one of those momentum arrows, the PPS indicator, and I'm looking for a new change in signals of not whether it's up or bullish, but I'm looking for negative, which is colored red, or it says down. I'm looking for a momentum change by the indicator, not my opinion. And so when we take a look at the sector ETFs here, what is strong is we started to see a breakup over a week ago in materials, transportation's coming back, oil service sector's coming back. I'll cut to the chase. I think if we do see a sector rotational grind, this week we saw a new reflective change in biotech, IBB. It's flashing, so you can see it generated a new fresh weekly buy signal. So I think, we're starting to see a change in money flowing into some of the biotechs. That's for starters. So we have IBB starting to carry some weight to the upside. And if we go up to, or down to, excuse me, semis, where this is what I was reporting. Semis, this SMH, while it does not have an official sell signal, there's a buy signal or an arrow pointing up. It does not have one of these. It doesn't have a weekly sell signal. But the momentum of the market, the volume of the market, everything is starting to weaken over a higher degree time frame. So I'm looking to see if we turn and reverse. And what I'd be looking at is we had on a daily basis. So it starts from somewhere, right? So we look for higher degree time frame trend changes, but we also, if we're anticipating a seasonal shift from strength to weakness in the semis, then we want to start looking at the shorter term to see if it's actually turning around. And here's a funny thing, looking at the semis on the SMH on a relative daily basis, well, we got an arrow pointing down on a daily basis on the semis for starters. The relative strength isn't turned negative quite yet, but the on-balance volume, my volume indicator, and again, the momentum of the market is starting to fall. So therefore, I'm looking for a breakdown. If we get a close and confirm multiple day lower high, lower lows and close underneath this line in the sand, then I'm looking for more follow-through weakness to ensure that we're going to get from a daily sell signal and then revolve into or cascade up into a weekly sell mode. And that'll give me confirmation that if the semis roll over, then perhaps the Qs can maybe stall and not advance as much. But I'm looking for sector rotation into stuff that has just absolutely been beaten down with an ugly stick. And some of those sectors, many of you will recognize for sure consumer staples. Consumer staples, not only has it been beaten down with the ugly stick, when I say consumer staples have been beaten down with an ugly stick, it's one of the very few sectors that's near a, I wouldn't say 52-week lows, I would say 104 weekly lows. I mean, we go all the way back since 16 before we start to see prices this low. So when you want to talk about relative strength versus the market, we're back to prices not seen since the beginning of 2016 in the staple sector. I mean, the overall market's up to new highs, and this thing's down to almost 2-year lows. So that's got to tell you if there is value and if there is some remaining strength coming into the market, or if there's a sector rotational grind, maybe getting out of some stuff that's been up too much and getting into some things that are value plays. So that's why I'm going to be looking for a rotational grind into some of the staples, and some of the names, I mean, are just ugly as could be. I remember Mike M. The other day reminded us that when we talk about different ugliness, Campbell's Soup is one of those stocks. So CPB, Campbell's Soup, when you want to talk about is there potential for the sector to go down even further? Well, individual stocks can weigh in on the market, but boy, Campbell's Soup, when you want to talk about ugly stick, this has been beaten with the ugly log. I mean, this thing got just, I mean, it's almost back down to where it was in 2013, gang. So if there's a shot that someone says, maybe I got too much risk exposure in high-flying stocks like a NVIDIA or like a Micron or things of that nature, perhaps they may find value in a less expensive stock that still pays a dividend yield, and other names in that space that weigh in on the sector itself is Clorox, and Clorox hasn't done that well at all either. But other names, like for example, a Kellogg's, Tony the Tiger, they also manufacture the parent company for Pringles, a well-staple item that we all need when we travel on long-distance plane rides. But anyway, with that stated, there are other names in this space that I think we are starting to see some kind of turnaround in the market, especially as you can see the relative strengths improving. We don't have great volume, but we have relative strength improving in some of these names, and we're going to start looking for that sector rotational grind in the marketplace. Metals and mining have just gotten killed. And I think one of the other things that we wanted to point out to you, like a Walmart, for example, when we look at retail stores, gang, Walmart is the behemoth, the 800-pound gorilla. I mean, as far as a brick and mortar is concerned, I mean, Amazon is what everyone really looks at, but Walmart is, I mean, if you take a look at Walmart, the price direction relative to the other market, Walmart is actually trading near a kind of an important support level, which is a monthly support target. So looking at the weekly stock, one of the things I want to point out about Walmart is that while it is near monthly person's pivot support, we have a little convergence pattern on the momentum, on balance volumes pointing up, relative strengths improving, and the PMC indicator is sharing that this market, from a histogram perspective, is at one of the lowest level readings that we've had since October of 2015. So I would say short term, we may want to look at some of the names in this space, but in this consumer staples, some stocks are posed to rally first and give more of a tradable low, a tradable short-term bounce more than others. So with that stated, Walmart is one to kind of keep your eye on and look for maybe reversals on a shorter-term time frame. Start with your 60-minute, and you want to look for some kind of a bounce. And I would say is if you got a 60-minute close, right, say yonder north of 84.5, this last conditional change resistance on a 60-minute basis, there's another area or for stock traders that I'd be looking for confirmation that it is doing a little bit better and that we could get that 84.5 area. We could see just north of there a recovery and give short-term traders a little boost. So watch for Walmart, 60-minute close above that. And you ought to get a nice little swing trade a day or 2, 3 days out of that on a recovery in the marketplace. All right? So that's coming to things that I'm looking for the semis to show some more relative weakness, and I'm looking for that sector rotational grind, and that may affect the way the holdings or weightings of the different indices are moving right now. As far as other markets, and I know we could come up with something better than Walmart, but you know, this week we do have some earnings in this space of the retail sector. We got Target, for example. So Target, relative to Walmart, is breaking out. Remember, Wednesday is Target. We have Wednesday is Red Bullseye shopping day, but it's closer to its highs, not its lows. So relative to the rest of the market, you have Target. Now, TJ Maxx is not a competitor of Walmart to a degree, but TJ Maxx looks just almost the same type of pattern as TJ Maxx and Target both have a relative higher trend kind of grind, and pattern looks very similar in nature. So in this space, we have Kohl's is one last one, and Kohl's had a really lot of popularity last year as they were rumored to have been partnered with Amazon, and that seemed to have died out. But again, it seems that Target, TJ Maxx, and even Kohl's all have that relative same pattern where they've just not done a whole lot recently, but the relative strength and the volume is picking up on some of those, and it could be maybe just ahead of bullish expectations on earnings for this coming week. So keep that in mind. Other than that, gang, we have crude oil, which admittedly, I was looking for a pullback in crude oil because we were starting to see relative weakness in the market in prices, and I was looking for, as not to be a seller of crude oil or oil sector stocks, I was looking to jump back in on a pullback. And of course, through the middle of the week, as you know, we broke back down, we got a pullback, but boy, was not anywhere near what I was expecting or hoping to see. And so with crude oil, they did slip one past me, not short the market, but missed trading opportunities. But here's the thing that I got to say. Do I feel that crude oil, should we be chasing it? Do I feel that we could see the pullback still? We come in today and we see oil service sector as still OIH, and that's the one I wanted to buy on a dip because I thought it relative longer term looks stronger. So sometimes our analysis, by looking for a pullback, we don't get it, but that's why I don't like to sell markets first. I like to, if they're longer term bullish, I like to buy that pullback. So the question begs, can crude oil, does it have the capacity to pull back? And the answer is yes, absolutely. The relative strength, the market is starting to show a waning volume action. My histogram component is starting to lose its positive momentum, and the volume analysis as well. It started, as you can see, it's maybe hard to spot for TradeStation, but this momentum indicator of volume has started to show some divergence. In other words, the momentum is going down. It turned a little red right there as prices have gone up. So when volume starts to lose its positive momentum, it shows a divergence, and it shows that the market is, keyword, vulnerable for a decline. So I am still thinking that we're vulnerable for decline, and it would have to probably come from a daily close underneath this white line in the sand. Remember, these are the last additional changes. This is an indicator. If we get a daily close under 70.50, then we're going to be seeing how much of that pullback can we expect. Seem to be a lot of support, a lot of buying going on around 68. I don't know if that'll be enough in my mind for to move the needle much in oil service sector stocks, but I have to say I think we do have a shot at that pullback. And once again, I don't know if it's going to be this week because of the fact that it's Memorial Day holiday on Monday, so we won't be here next week with you guys. Number two, it seems that there's always an increase in purchasing of crude oil by refiners, and gasoline always costs more at the gas stations for Memorial Day when people want to go and check out their maybe summer homes in Wisconsin and Chicago or Michigan, or we go somewhere, the Indy 500, stuff like that. We get to more traveling, graduation, picking up kids from college, and it always seems that the ladders are quick to come out to move prices up, and then the ladders break, so the prices don't really come down at the pump. But again, it's that same old story. I think after next week is when we can more importantly expect to see maybe a pause in the market. So while we're up against a pivot resistance with these conditional changes in the market with these indicators, I'm not one to being bullish on crude oil or the energy sector now. I'm looking for a pullback to buy. I won't short it, but again, I just can't bring myself to buy it. I'm looking for other opportunities in that case. Looking at gold prices, we had the same situation, and it's almost the same type of a call here, that we were calling for the market to maybe pull back as low as the 1250-60 handle. As prices were moving up, we didn't get long the market at resistance. There's just no chance in gold that I was a buyer or bullish on gold, and I had been stating for quite some time with the indicators. And that's, I think, what the market does its best at, is it tries to scare us and trick us as much as possible. Delayed reactions. So, you sit there and you watch and you watch and you watch, and you're stalking the market, and you're patiently looking for the turn, and then all of a sudden it comes out of nowhere. And that seems to be what this market does a lot in the last few years, right? And it definitely has like that time bomb effect, whereas the market seems to move up in price, there's no volume, and then all of a sudden volume catches up later, or the opposite is true. And like for gold, the indicators were starting to show the same sequence of events that the market is displaying for crude oil is starting to be shown, or excuse me, the same sequence of indicators seem to be showing for gold that showed up in gold are showing up in crude oil. So as gold was rallying, and I'm like, guys, I can't chase this. We're up against pivot resistance. The momentum of the market is moving lower. Look at the histogram of price and look at my volume indicator. It actually turned red. So when we finally got a sell signal, it was vulnerable for a price decline, and we were looking to take sell signals, not buy signals. And so as we get an intraday low last week near 1280, we're going to get the rollover from June to August, and now we got that going for us. So a lot of things are changing as we conclude this trading week. So I just wanted to show you a case study of why would I not want to be a buyer of gold, crude oil at resistance when I have very similar readings in crude now that I had in gold last month. So I just wanted to demonstrate that as far as what I find to be very valid indicators. And so while I may miss an opportunity in a market, I think it helps us to avoid potential landmines as well from a swing trading perspective. Day trades, there will always be a day trade, but as far as looking forward into the next week or so, I would imagine that we're still going to see maintain momentum strength. Maybe we're not going to crash, but I don't expect a huge rally out of crude this week unless something disastrous happens in the Middle East, supply disruptions, something of that nature. But I definitely sense that crude oil will probably start to see or remain in a, as we started to see a contraction over the last couple days, a contraction of its daily ATR's average true range or its daily trading ranges, which reminds me to point out that right now, ES is back down to a 23, just slightly under 24 ATR right now. The S&Ps have gone from 9 last October. Remember October, we were at 9. It was like painful to day trade in S&Ps. We went up to a high of, I think, on a daily basis, it was as high as 61 from the ranges that was the conclusion of February. And then we dropped down to 40. Well, now we're at 23 in the S&Ps, in the ES. So looking at the rates of change in the market, we're starting to already see the ES, and here is the ATR right here. The current range this morning right now is 12 points, and we have an average true range of 23.77. What does that dictate? When ranges contract, it senses more times than not on contraction of ATR, you see prices rise. It's when prices fall that we see that expansion in the average true range. It's not true for every single situation, but it has relevance in the field of technical analysis. So therefore, I see that the ES can still see some upside, and I think we're going we're getting that delayed reaction. And that's what I wrote about for this week. And I think that as far as the Russell is concerned, we got this breakout. It is moving. I don't want to short the market, but I'm not long. I'm actually switched into gear, expecting relative performance in the S&Ps now to take over. And as far as the NASDAQ is concerned, I think it has weighting problems due to the semi sector. We'll see if that pans out. Anyway, that's my introduction for this week. As far as what we see happening, and I hope that I didn't spell too much time about indicator analysis, the power of relative strength, as well as where we're seeing, as far as equities are concerned, that rotational grind and where we should see money come out of and where might see money going into. So biotechs, drug sector, and staples, keep your eyes on that for long positions for this week. Until 2 weeks from now, gang, have a great holiday, everyone, Memorial Day. Thank you to all our veterans out there, and thanks for those who have family that have served and we've lost defending our country. We want to say thank you very much, because that's what Memorial Day is all about. With that said, TradeStation, we'll see you in 2 weeks. Thanks everybody.